Welcome back to Commercial Real Estate Now. I'm your host, Carly Iacono. Today, I'm covering the sale leaseback playbook, who's doing it, why it's working, and what most people get wrong. Let's start with where the sale leaseback market is right now, because the numbers tell a more specific story than the broader net lease headlines. The U.S. sale leaseback market closed 714 transactions in 2025, a 3% increase year over year. But aggregate dollar volume jumped 18% to $14.4 billion, the highest level since 2022. So transaction count was relatively flat, but dollar volume was not. Now that gap tells you that deal size is growing and larger corporate transactions are coming back to the table. Q4 alone saw volume spike 56% over Q3, driven by the return of larger deals and a pickup in M&A activity. On pricing, single-tenant net lease cap rates averaged 6.88 through Q3 2025, effectively flat over a prolonged climb. Now, we are starting to see moderate cap rate compression from the second half of 2025 into early 2026, with improved pricing creating more attractive execution windows for sellers. So that's meaningful. When the pricing environment tightens in the seller's favor, the arbitrage between real estate yield and business return on capital gets more compelling, not less. Now let's move to who is doing sale leasebacks right now and why. Nearly $957 billion in commercial real estate loans matured in 2025, close to triple the 20-year average. And the Mortgage Banker Association projects another $875 billion will be coming due in 2026. That refinancing pressure is pushing CFOs to look at every available capital option, and sale leaseback is legitimately on that list. Now, the average rate on new CRE debt is running about 150 basis points above the rate on maturing loans. So for a company with clean financials and a strong operating business, a sale leaseback can be a smarter, cheaper path to liquidity than a refinance. But here's the critical distinction. A sale leaseback works when the business can sustain the lease. It really is not a rescue mechanism. If a company is facing genuine financial distress, cash flow problems, covenant pressures, deteriorating margins, executing a sale leaseback doesn't solve that. It converts a real estate obligation into a long-term lease obligation, and a tenant that can't service its debt almost certainly can't service a 15-year triple net lease either. Buyers underwrite that risk and they price it accordingly. The companies getting the best execution right now are financially healthy operators who are choosing to redeploy capital, not companies trying to buy time. Public companies are using sale leasebacks as non-dilutive capital, no equity offering, no earnings drag from new debt service at elevated rates. They unlock the balance sheet, redeploy into M&A, CapEx, tech infrastructure, or debt paydown, and maintain operational continuity. Private equity sponsors are using it differently. They're extracting value at acquisition or post-acquisition while preserving operational control. Now, both groups are active in the same sectors: logistics, automotive, healthcare, and select retail, specifically where retail unit level economics are proving durable. The real estate is just the wrapper in these situations. What the buyer is actually underwriting is the operating business behind the lease. Now let's move to the part of the market that I think is genuinely underappreciated: middle market sale leasebacks. Now, middle market is different in ways that most institutional frameworks don't fully account for. When a business with 30 or 40 million in revenue executes a sale leaseback, this is often the single largest liquidity event in that company's history. The real estate may represent 60 to 80% of the owner's net worth. The stakes on both sides of the table are categorically different from a corporate transaction. Credit underwriting in the middle market is idiosyncratic. You're not looking at public credit rating or an investment grade covenant package. You're going through financial statements, management depth, customer concentration, and margin durability, often for a business that has never had to open its books to a capital partner before. So that transparency gap is real, and it can be a deal killer if you don't address it early in the process. Buyers who try to apply institutional credit screens to middle market deals will miss the transactions that are actually sound. And on the other side, sellers who don't prepare their financials to tell a coherent credit story will leave money on the table. Moving on to deal structure, and this applies across the market at large. A few things have tightened materially. Now, lease term remains the primary pricing lever with 15 to 20-year absolute net, triple net as the default expectation. Fixed annual escalations are standard, but options at fair market value with a fixed floor are currently in vogue. Another change is the credit support conversation. Tenant credit is the asset, and buyers are underwriting coverage ratios, more explicitly. Residual value math is getting more attention than it did when rates were low and refinancing was easy. If the tenant doesn't renew at the end of the term, what does that real estate actually trade for? That question used to be an afterthought, and it's now a line item. Let me close with a math that gets overlooked. A company executing a sale leaseback is, in effect, trading a real estate asset for capital it can reinvest into its core business. The question is whether the return on that reinvested capital exceeds the implied rent yield on the lease. For most operators, particularly in logistics, healthcare, and manufacturing, the answer is yes. The implied rent yield on a 15-year absolute NNN transaction might be in the mid-sixes. A well-run business in that category is typically generating returns on invested capital well above that. So the arbitrage can be a real benefit for operators. However, it is crucial that the seller understands that the buyer is paying a premium for duration, credit, and contractual rent growth, and they have to be willing to be bound by the long-term lease. That's the framework. Sale leasebacks are not a distress tool. In this market, they are a capital allocation decision for sophisticated operators who understand the full picture. Thanks for listening to Commercial Real Estate Now. If you found this useful, share it with someone in the market. And if you want to go deeper on net lease or sale leaseback strategy, reach out directly. I'm always happy to talk specifics. Thanks for tuning in.